Welcome back to Beyond the Benchmark. I'm Ryan Kasper. This week, the economic data calendar finally started to normalize after months of delays tied to the government shutdown. And with that, we saw a mix of updates that painted a picture of an economy cooling, but still holding together in key areas. Personal income rose 0.4% in September, slightly better than expected, while personal spending increased 0.3%. Both income and spending are running around 5% over the past year, meaning consumers still have positive real spending power even after inflation. The PCE inflation numbers were steady, headline and core both up 2.8% year over year, unchanged enough to keep the Fed comfortable heading into this week's policy meeting, where markets are anticipating a rate cut. On the softer side, manufacturing continues to struggle. The ISM Manufacturing Index slipped further into contraction at 48.2, with new orders and employment weakening. Tariffs and global uncertainty were cited repeatedly as headwinds. By contrast, the services sector remains the economic workhorse. ISM services ticked up to 52.6, supported by rising business activity and stable new orders, even as price pressures remain elevated. The labor market delivered mixed messages again. ADP reported a decline of 32,000 private sector jobs, the sharpest drop since early 2023, driven by losses in professional services and information. But weekly jobless claims came in well below expectations, suggesting no sudden deterioration beneath the surface. Overall, the labor narrative continues to soften but not break. Industrial production rose slightly, up 0.1%, with AI-driven business spending and high-tech equipment continuing to show impressive momentum. Weakness in autos and consumer goods offset some of that strength, and capacity utilization stayed unchanged at 75.9%. Turning to markets, equities posted modest gains in the U.S., with tech and energy leading the way. Defensive sectors like utilities, healthcare, and consumer staples lagged as interest rates inched higher. The bigger story was overseas. Europe, Japan, and emerging markets all outperformed the U.S., helped by a softer dollar and optimism ahead of this week's Fed meeting. Within emerging markets, South Korea, Taiwan, and China were the standout performers, echoing the bullish tone around global technology and semiconductor activity. In fixed income, rising yields pushed most bond sectors slightly lower, with treasuries and investment-grade corporates seeing modest declines. High-yield and floating-rate loans were the only segments to post gains. A weaker dollar helped foreign bonds outperform in local currency terms. Commodities were mostly higher. Energy and industrial metals advanced several percent, supported by stronger early winter natural gas demand and some renewed geopolitical tension in Eastern Europe. Crude oil rose nearly 3% to about $60 a barrel. Precious metals held flat for the week. So, the takeaway: the economy is cooling, but not collapsing. Inflation is stable enough for the Fed to move forward with a rate cut. Services remain solid, manufacturing remains soft, and global equities are gaining momentum as the dollar weakens. Markets are positioning carefully ahead of Wednesday's Fed decision, which could set the tone for the remainder of the year. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll see you next week.